everyone, Julius de Kempenaer here and welcome to a new RRG video. Recording this on Thursday evening my time, the 6th. It's about an hour before the close and the markets are down sharply. So it is time to make an assessment of the current damage, looking through the RRG lens to see what the impact has been so far and whether we have to expect more going forward. As usual, our starting point is the relative rotation graph for US sectors. And this is the weekly version of that chart. And what you immediately see is a very high concentration of tails inside the improving quadrant and a very limited amount of sectors on the right-hand side. As you know, the right-hand side is the positive side of the graph and the left-hand side is the negative side of the graph. Relative downtrends, relative uptrends. And here you can see that a bunch of sectors are picking up relative momentum. And a few are going the opposite direction. As a matter of fact, only two sectors, technology and consumer discretionary, are on a negative heading, while all the others are at a positive RRG heading. Now, the problem is that technology and consumer discretionary are the biggest sectors in the market. They are the biggest drivers. So when they start to turn around and add negative relative strength, a lot of stuff needs to happen to offset that. And it is happening, but not enough to keep the market afloat. So that's why we see the S&P falling at the moment. We do a quick assessment of the tails here on this weekly RRG. I think that, as I said, technology and consumer discretionary, there's no doubt these are very weak sectors at the moment from a relative point of view. And then we have the positive readings for financials and communication services. Those are still intact, they're in play, they're inside the leading quadrant, and they're at a positive RRG heading. And you can see a whole heap of sectors that are also at a positive RRG heading. And obviously, the defensive sectors are picking up. So utilities, healthcare, and staples, XLP, are on the forefront. So far, this RRG tells us that especially consumer discretionary, communication services, financials are still good. And these are relatively cyclical sectors, which are usually indications for a bull market. Now, it's hard to believe that with the current prices that are going on, to say or believe or position yourself for a full-fledged bull market. It's also not what I would tell you to do going forward, but you got to keep in mind that the underlying tone with those sectors still on the right-hand side is not a massive problem. It's a problem right now in the near term, but so far we're holding up quite well. The question is whether we will be able to do that going forward. Now, if we put this chart to a daily version of the RRG, then you will see a bit of the opposite. Here you will also see technology inside the lagging quadrant at a negative heading. So the weakness in the technology sector is confirmed on both the weekly and the daily RRGs. That is a problem because it is the biggest driver in the market. What we also see is that consumer discretionary is far to the left. It's picking up a little bit of momentum, but it's far to the left. It's got the lowest RS ratio reading, which is combined with technology also a problem because these two are driving the market. So for both technology and consumer discretionary, the daily and the weekly RRGs are signaling weakness and they're signaling more weakness ahead. If we switch over to the other end, so this is a daily RRG, that's relatively short term. You can see that industrials, financials, materials, healthcare, real estate, staples, they're all on the right track. They're all pushing forward and picking up relative strength. Now, this is a good time to remind yourself that relative performance means that it is very well possible that the price of a sector or one of these ETFs is falling and they are still showing up inside the leading quadrant as outperformance. And the reason for that is that SPY, the S&P 500, is falling even further. So if a sector drops by 2% and SPY drops by 5%, that sector is outperforming 3%. I can't stress that enough, and it's something that a lot of people have a very hard time grasping and understanding, but that is the core of relative strength analysis. It's the core of a relative rotation graph. If we have a real quick look at things, so here is energy, is a sector which is inside leading but rolling over. That is one that is already, moving back down. And the same is happening for utilities. Utilities, as we know, on the weekly was pushing into the leading quadrant, and here you see that it has started to roll over, still on the right-hand side. So the defensives are still in the lead. Again, my take on current rotations is that obviously technology and discretionary are at the moment the ones that are very responsible to drive the market lower, which are driving the market lower. But so far, there is a lot of offset in the other sectors. It's not strong enough to keep the S&P afloat or the S&P 500 afloat, but it's also not super negative. It would be super negative if technology and discretionary would be in lagging very deeply, and then the other sectors would be very close to the benchmark. That would be a very, very negative reading for this sector rotation, but that's not happening. Not happening yet. I don't know what's going to happen going forward, but at the moment, it's painful at the moment, but it's not a disaster. Let me put it like that. Let me start with the charts of the two most painful sectors. So that's technology and consumer discretionary. Here is my chart for technology. This is the chart that I always use here in this show. We have now very clearly left the rising channel, and we've discussed the inability to break above that overhead resistance for quite some time. And what you see now is if I can't break to the upside, you will fly down, and right now we are breaking the lower boundary of that trading range, and you could actually argue that the technology sector is breaking a double top or is completing a double top formation. In any case, it's not positive. We're breaking support, we're breaking rising support, we're potentially completing a double top formation. That means that we're now in a situation for the technology sector that the upside potential is very limited, like probably towards the old support level, which is around 220, 225. And the downside is pretty wide open. I'm going to label the first area of support somewhere between 210, 205 and 210, which is this previous high here and then this previous low here, which is 205, 210, which is not too much, like 5 to 10 points lower, but it could happen as support. If you look at the relative strength, that's why this sector is showing up inside the lagging quadrant, is the rollover in raw relative strength, and it's very close to breaking out of that range and the turnaround of the RRG lines. So not much upside potential for the technology sector in the next few weeks. Here is the consumer discretionary chart, and also here a completion of a top formation. Not exactly a double top, although I could argue that this extreme here, if we leave that out, it could be seen as a double top, but in any way, it's a trend ending characteristic. It's been executed and we're moving lower now. This means that consumer discretionary from a price perspective is now in a series of lower highs and lower lows, i.e. a downtrend. And the first support level, which I have marked here around just above 200, 203. But as you can see, it's only minor. It's just those two small intermediate highs. The result of that decline in price is that relative strength is now rolling over, and so are the RRG lines. The reason why consumer discretionary is still on the right-hand side of the graph inside weakening is because of the recent strength of the RS ratio metric. Because of the height, it needs time to roll over. That's what you see here with momentum rolling over. That's the indication, the kind of early warning indication that this sector was going to go lower from a relative point of view. If you want to take a positive stance on this, then the fact that this RS ratio was so high means that it had such a strong relative trend. And if you look at the RS line here, I can argue that this came out of a long-term downtrend and that we're now seeing the first setback after that long winding downtrend. Let me add two trend lines. Let me add a trend channel on this chart here. And we see that consumer discretionary from a price perspective is now nearing a support zone. As I said, it's the 203 area. And then if we would look at the connection of these three lows, it's absolutely not perfect, but the top line, the old resistance line, is a little better. You could argue that in this area, there could be some support. And if that happens, if we hold here from a price perspective, that would give the RS line time to consolidate and start moving higher, which in return would cause the tail on the RRG to curl back up, which is what you very often see in strong relative trends, that we have that massive run up and then we see a rotation. People who watch these videos more will know it, from leading to weakening and back into leading. And these are usually very strong moves. So I'm keeping the option open that consumer discretionary will be able to make such a move, especially because it has still such a high RS ratio reading. When we move to the chart for SPY, then we are in the danger zone right now. We saw discretionary and technology completing that top formation. SPY is about to do the same, but we're not there yet. This is a weekly chart, so we have to wait until tomorrow, Friday's close. And if that close is clearly below that dashed line here, then we have a completed double top, and we have to take into account that there will be more downside for the S&P 500. But with the current events unfolding on a day-to-day basis, I am not going to front run that break. I'm going to wait until tomorrow before we see it. And it may mean that we're sort of missing the first part of that decline, but I need to be sure because, the last couple of days, markets have been crazy. They go up in percentage points, they go down in percentage points. So I could easily see a situation where we are kind of breaking now, and then tomorrow at the close, we're right back in here. And then we all say, well, this was not a break. It was just a little flimmer below support. And then we went higher. So no front running here. If it happens, if we break that 575.35 is the low here on a weekly basis, then I think we have to take into account that this double top has been broken. And it means that the target is this arrow here. And you can see that it is pretty much right on the dot in that old trend channel, that old resistance line, which has acted as support 2 times before. And it could very well do that again. The 565, I've dashed that here and make it a little bit lighter because I think that if this is really a break, then that 565 support is probably not going to be very meaningful. If it happens, I'll be very happy, but because it means that there's enough support for SPY. But in all honesty, I think that if that pattern completes, that we are more, the odds are higher that we move to the 540 area than that we're sticking around 565. We will see that in more detail on the daily version of that chart. It's the same chart, a little bit less annotations, but this is the same target from completing this double top. And you can see here how strong that move lower has been. We're going into that support area. There is a support area here, 565, 575. But again, on the weekly, if we break that low here, that 575, the target, we have to see it around 540. So I'm going to leave it at that for now for the SPY chart. And we just have to wait until tomorrow's close before we start drawing any conclusions. Now that we've seen the chart for SPY, I want to focus a little bit more on the RSP chart, the equal weight version of the S&P 500. And what we see here is that this chart looks very different from the SPY chart. This chart, RSP, has not broken below its previous low yet. So this is still, theoretically, we've got a lower high, but we don't have a lower low yet. And if you look at the relative strength of RSP versus SPY, you can see that it is now moving sideways. So here in this period, actually RSP, so equal weight, underperformed cap weight. That's the run up. That's the strength of Mag 7 and the mega cap stocks. That has come to a rest in the second half of last year. And now these last lows here are in the same area, in the same range as the low that we saw in July. So from a relative strength point of view, RSP is now picking up strength versus SPY. And that's interesting because what that means is that the mega cap stocks, the Magnificent Seven, are losing their strength because that little top layer in the S&P 500, which is getting hammered right now, is causing SPY to go down because their weight is so high. But the others, there's plenty of other stocks inside the S&P 500 that are not that bad. And that's what this chart is telling you, that RSP is actually now starting to outperform SPY. And if that happens, it means that the market cap is taken away, the market cap impact is taken away, and then we are seeing a, so far, relatively mild correction in the S&P 500. Again, SPY obviously is what everybody's watching. That's what we're watching as well. It's impacted by a lot of market cap, but this chart is telling you that the biggest is in the mega caps, and that's where we see it happening. Just wanted to make you aware of that subtle difference that we're now seeing, where it looks as if we will have RSP taking over from SPY, which means that there is more focus on S&P 500. They're all large cap stocks, let's be honest. They're all large cap stocks. But the mega caps are slowing down and others are picking up in that universe, which could mean that we will see a similar situation as to what we've seen from 2020 all the way up to end of 2023. Start of 2024, we saw that moving around. So here, this period, RSP was actually outperforming SPY, and here SPY was outperforming RSP. So are we seeing a turnaround here? I don't know, but I definitely want to keep an eye on it, because it means that the underlying trend in large cap stocks might not be too bad. And then finally, here is the comparison between stocks and bonds. I'm using SPY versus IEF. And what you see here is a turnaround. Here is a top formation. We broke below the previous low, so we've completed this top formation. We're now resting at support. So this ratio now is at 6.05, which is kind of in this top formation that we had in the middle of last year. What this tells you is that bonds are now getting more attractive than stocks. And if you look at the divergences in the RSI and the MACD, I think the conclusion has to be that for the time being, bonds have to be preferred over stocks. That's from an asset allocation point of view, and that's what this chart is telling you. And a quick word for those of you who are following my series of articles, the best 5 sectors, which I do every week at the end of the week. I can tell you that, and this is a very strict model, so I can't, during the week make changes, so we have to wait until Friday. But I can run the model during the week, and I can tell you that this week, already on Tuesday, technology dropped out of the top 5 sector because it was the weakness. So unless something really crazy happens today and tomorrow, technology will be out of the top 5 at the end of this week, and it will be replaced by utilities. So this is with a lot of caveats, and you got to wait until tomorrow, but communication services remains number 1, financials remains number 2, discretionary remains number 3 as it is right now, believe it or not. And then we have technology dropping out of the top 5, and it's going to be replaced by consumer staples. As I said, this is not graved in stone yet. We're going to wait until tomorrow, but just a heads up, this is what it looks like at the end of tomorrow, unless really, really big changes. I will update the article tomorrow and the positions in the portfolio as well, and we will keep on tracking it. The performance so far is, it shifts a little bit of a few basis points outperformance, a few basis points of underperformance. And I'm actually quite happy with that you have a portfolio, because it's a long only portfolio and you need to make a dent. You need to make your outperformance over a longer period of time. We have just started this in January, so it's about 7 weeks old. That is not enough to draw any conclusions. We're still holding up. We're in line with the S&P 500, which is good enough for the time being. We'll keep doing this to the end of the year, so keep following it. But as I said, unless anything crazy happens in the last 30 minutes of trading today and tomorrow, tech will be out and staples will be in. As usual, thank you very much for watching. I hope you enjoyed the show. And as usual, please share your thoughts and ideas in the comment sections below the video, and we'll have a chat there online.